Before you turn 70, there are 3 IRA assets sitting in your account right now that the IRS is counting on you to leave exactly where they are. And if you do, they will cost your family $80,000 or more in tax that never had to exist. Not $80,000 in total tax. $80,000 in tax above what you would have paid if you had moved those assets before your 70th birthday. The difference between what the IRS collects under your current trajectory and what it would collect if you converted before 70 is the number most financial advisors have never shown you on a projection, because showing you that number would require them to recommend a strategy that shrinks the account they charge basis points on. The IRS is not waiting for your advisor to bring it up. It is waiting for you to do nothing. Sandra and Robert Finley are 64 and 67 years old. They live in a brick Tudor in the Webster Groves neighborhood of St. Louis, Missouri. Robert retired 18 months ago from a 30-year career as a commercial insurance underwriter. Sandra still works 2 days a week as a registered nurse at a pediatric clinic, a schedule she has held on to not because she needs the income, but because she loves the work and the kids. Their refrigerator has a drawing from a patient that Sandra framed years ago. Robert makes a legitimate gumbo every January. They have $740,000 in Robert's traditional IRA rolled over from his 401k at retirement. Sandra has $185,000 in her own traditional IRA from her years of hospital employment. Combined traditional IRA balance, $925,000. They also have a $140,000 joint taxable brokerage account, a paid-off house worth $415,000, and a joint savings account with $54,000. Their current household income, Sandra's 2 days a week nursing salary of $34,000 per year, and Robert's small pension of $18,000 per year. Total, $52,000. Their federal taxable income after the standard deduction, approximately $21,800. Their marginal federal rate, 12%. Robert turned 70 in 3 years. Sandra turned 70 in 6 years. Here is what changes at 70. Robert begins Social Security. Based on his earnings record and his decision to delay to 70, the maximum benefit strategy, his monthly benefit is $3,840. Sandra, claiming at 70 as well, receives $2,210 per month. Combined Social Security income, $72,600 per year. Add Robert's pension, $18,000. Add Sandra's nursing income, which she plans to continue through 72, $34,000. Total household income at 70, $124,600. Their taxable income at 70, after the standard deduction for married filers both over 65, which by 2029 will be approximately $31,000, is $93,600. Their marginal federal rate, 22%. Missouri state income tax on their combined income, 4.95%. Their effective combined marginal rate on every new dollar of income in 2030, 26.95%. Compare that to today. Today, in June 2026, their marginal rate is 12% federal plus 4.95% Missouri. Combined, 16.95%. Every dollar they convert today costs 16.95 cents in marginal tax. Every dollar they convert at 70, after Social Security activates, costs 26.95 cents, 10 cents per dollar. On a $925,000 traditional IRA, that 10-cent differential, applied to whatever they fail to convert before 70, compounds into a number that sounds abstract until you calculate it, conservatively $80,000 to $105,000 in additional lifetime tax, paid purely because the conversions happened at the wrong point in the income calendar. The window between now and Robert's 70th birthday is the lowest income, lowest tax, highest conversion efficiency period the Finleys will ever experience in their retirement. It is 3 years wide. It is wide open today, and it will close permanently on a specific birthday with mathematical precision, whether they use it or not. That is the crime scene, not a trap that snaps shut, a window that closes. And the cost of letting it close is the same $80,000 whether you knew about it or not. If that number, the 10-cent differential, the $80,000, hits the way it should, smash that like button right now. Because the 3 IRA assets I'm about to show you are the exact conversion targets that maximize the value of this window before it closes. Let's build the full pre-70 conversion math. Because the $80,000 headline is the summary. The mechanism that produces it has 5 distinct damage layers, and each one is independently significant, which means even a partial conversion strategy that addresses only some of them still recovers real money. The suits at the agency want me to remind you this is not financial advice. It is a survival guide for an unguarded vault. Talk to a fiduciary CPA before you move a single dollar. Today, the Finleys' taxable income is $21,800. The top of the 12% bracket for married filing jointly in 2026 is $96,950. They have $75,150 of bracket room at the 12% rate, room that right now exists and is being wasted. Every year between now and Robert's 70th birthday that they do not convert, that $75,150 in 12% bracket room expires unused. It does not carry over, it does not accumulate. It vanishes on December 31st and regenerates on January 1st. And then at 70, Social Security income fills that space permanently, leaving no room for 12% conversions. At $75,150 in annual conversion capacity at the 12% rate over 3 pre-70 years, 2026, 2027, and 2028, the Finleys can convert $225,450 from traditional to Roth at a federal rate of 12%, plus Missouri's 4.95%. That is $37,900 in total tax on $225,450 converted, an effective rate of 16.83%. If those same dollars are converted after 70, stacked on top of Social Security income, the marginal rate is 22% federal plus 4.95% Missouri, 26.95%. Tax on the same $225,450 at 26.95%, $60,759. The difference, $22,859. That is the bracket compression premium, the tax savings from converting at the right point in the income calendar rather than the wrong one. Medicare's income-related monthly adjustment amount uses a 2-year lookback. The Finleys' 2030 Medicare premiums will be based on their 2028 income, in 2028, still before Social Security at 70. If they have been executing Roth conversions at $75,000 per year, their 2028 MAGI will be approximately $127,000. As married filers, the IRMAA Tier 1 threshold is $206,000. They remain below it. Their 2030 Medicare premiums stay at the base rate. Now model the do-nothing scenario. In 2028, they take no conversions. Their 2028 income is $52,000. Fine. Then in 2030, Social Security activates. Their MAGI jumps to $124,600. They remain below IRMAA Tier 1 in 2030. But in 2031, Robert's first RMD from a now $850,000 IRA balance, grown at 5% annually, adds approximately $32,300 to their income. Their 2031 MAGI, $156,900, still below Tier 1, but their 2033 MAGI, with RMDs growing, Sandra's RMD beginning, crosses $206,000 and enters IRMAA Tier 1 permanently. The pre-70 conversion strategy, executed at $75,000 per year for 3 years, reduces the traditional IRA balance from $925,000 to $699,550. The resulting 2033 RMD from a $699,550 IRA is approximately $27,600 instead of $35,800. That $8,200 annual reduction in RMD income keeps the Finleys below IRMAA Tier 1 for additional years, potentially permanently, saving $1,776 or more per year in Medicare, surcharges compounded over a 15-year period. IRMAA savings attributable to the pre-70 conversion window, approximately $26,640 over 15 years. When Social Security income enters the picture at 70, it does not arrive alone. It arrives carrying the provisional income calculation that determines what fraction of it is taxable. At the Finleys' income level, post-70, $124,600 before RMDs, Their combined provisional income exceeds the $44,000 threshold at which 85% of Social Security becomes taxable. The $72,600 in combined Social Security income, 85% taxable, $61,710, added to their MAGI every year from age 70 forward. Every RMD dollar they take after 70 does not just incur its own tax. It sits on top of $61,710 in already taxable Social Security income, which means the RMD pushes them up the bracket stack rather than filling room at the bottom. The pre-70 conversion, which reduces future RMDs, therefore reduces the total income that interacts with the Social Security taxation structure, creating a secondary tax saving on top of the direct bracket compression saving. Robert and Sandra have 2 adult children. Under the Secure Act's 10-year liquidation rule, confirmed by Secure Act 2.0, their children must empty any inherited traditional IRA within 10 years of the parents' deaths. Robert and Sandra's children are in their late 30s and early 40s. Their marginal income tax rates during the 10-year distribution window will likely range from 24% to 32%. On a $699,550 traditional IRA at 28% blended rate over 10 years, the inherited IRA tax, $195,874. On the same dollars converted to Roth before 70, qualified distributions, 0 tax, the inherited Roth IRA tax, 0. The cumulative damage across all 4 layers, bracket compression tax delta, IRMAA savings, Social Security interaction reduction, and inherited IRA tax elimination, approaches $120,000 to $145,000 in total lifetime family tax savings from a $225,450 pre-70 conversion executed at 16.83% against the conversion cost of $37,900. The net financial benefit, $82,000 to $107,000. That is the $80,000 figure. That is the number the IRS is counting on you to leave on the table. Tell me in the comments right now, how old are you this June 2026, and have you ever had a fiduciary CPA model the tax difference between converting before and after Social Security begins? Yes or no? That model is the single most valuable financial document most people in their 60s have never asked for. Here is the open loop I need you to hold through the villain section. The third IRA asset in this bulletin is not a traditional stock position. It is not a bond fund. It is a specific category of holding inside a traditional IRA that, when converted to a Roth, produces a tax advantage that stacks on top of the bracket savings, a double benefit that most advisors have never mentioned because it requires them to know both IRA distribution rules and capital gains treatment simultaneously. Hold that. We're almost there. Let's name the mechanism that produces this inertia, because the pre-70 conversion window is not obscure. It is not technically complex. It is documented in IRS Publication 590-A, visible to any CPA who models it, and provably superior in every scenario I have just run. The reason most families enter it and exit it without executing a conversion is not ignorance of the math. It is structural. The Secure Act of 2019 eliminated the stretch IRA, the provision that allowed non-spouse heirs to distribute inherited IRAs over their own life expectancy. The Secure Act replaced it with the 10-year rule. Secure Act 2.0, passed in 2022, raised the RMD age to 73 and eventually 75 for later birth cohorts. Both changes, marketed as gifts to retirees, had a structural effect on the advisory incentive landscape that has never been widely discussed. Here is the incentive map. A registered investment advisor or broker-dealer compensated on assets under management has a direct financial interest in the traditional IRA remaining as large as possible for as long as possible. Every dollar of Roth conversion removes a dollar from the AUM base that generates the advisory fee. A $225,000 Roth conversion at a 1% AUM fee costs the advisor $2,250 per year in perpetuity. Because Roth IRAs, once funded, continue generating advisory fees if the advisor manages the account, but the conversion decision shrinks the traditional IRA that anchors the relationship in the billing. The advisor who tells you to convert has to explain why they are recommending something that reduces their own compensation. The advisor who tells you to wait, to see how taxes develop, to evaluate market conditions, to consider your RMD situation more carefully, is not wrong to raise those considerations. But the wait recommendation benefits from the same structural alignment that benefits every other accumulation phase recommendation. Keep the money in, keep it growing, keep it billable. The IRS, for its part, built the tax code in a way that creates a genuine incentive to defer. Tax-deferred growth is real and valuable over a 30-year accumulation horizon. What the IRS did not publicize is the inverse. Tax-deferred accumulation creates mandatory taxable distributions at specific ages, which interact with Medicare premium calculations, Social Security taxation thresholds, and inherited IRA liquidation windows in ways that compound the deferred tax into a number significantly larger than the number that would have been paid during the accumulation years if conversions had been executed strategically. The pre-70 conversion window is the moment in the income calendar when the deferred tax is cheapest. It is the moment the IRS least wants you to act, and it closes on schedule on a specific birthday. Send this right now, before the bulletin ends, to one person in your life who is between 60 and 69 and has a traditional IRA over $300,000. Not someone who is already 73 and taking RMDs, someone who still has the window. The person you're thinking of right now, send it. The window they have today is the window they will not have at 70. 3 IRA assets, 3 conversion targets, executed before 70 in order of priority and tax efficiency. Save this video to a playlist titled Retirement Survival Manual right now. What follows is the conversion sequencing that a fiduciary CPA specializing in distribution planning would charge $3,000 to $6,000 to model and implement. The logic is here. The professional executes the precision for your specific account. The largest, most straightforward conversion target is the traditional IRA balance that generates the highest future RMD burden. For the Finleys, that is Robert's $740,000 IRA, now the primary driver of every post-73 tax interaction they will face. The conversion strategy. Each calendar year from 2026 through 2028, calculate the exact amount that fills from current taxable income to the top of the 12% bracket. In 2026, the Finleys' current taxable income is $21,800. The 12% bracket ceiling for MFJ is $96,950. Conversion capacity, $75,150. Tax on that conversion, $9,018 federal plus $3,720 Missouri. Total $12,738. Each year, the same calculation. Fill to the ceiling, pay the 12% rate, move the converted dollars to the Roth IRA. Over 3 years, $225,450 converted. Tax paid, approximately $38,214 total. Remaining traditional IRA balance reduced from $740,000 to approximately $514,550. Assuming 5% annual growth, the converted amounts are offset by new growth, but the distribution burden is materially reduced. The critical execution detail, the conversion must be completed by December 31st of the tax year to count for that year's bracket. A conversion executed on December 30th, 2028, 2 days before Robert's 70th birthday window closes, counts for the 2028 tax year and qualifies for the 12% rate. A conversion executed on January 2nd, 2030, after Social Security has begun, costs 26.95% on every dollar. The deadline is not a metaphor. It is a specific tax year calendar date. State nuance, Missouri taxes, IRA distributions, and Roth conversions as ordinary income at rates up to 4.95% for 2026. Missouri does offer a pension and Social Security deduction for residents over 62, up to $6,000 per person, but this deduction does not apply to IRA conversion income. In contrast, Illinois exempts all retirement income, including IRA distributions and Roth conversions, from state income tax entirely, making the pre-70 conversion window even more valuable for Illinois residents. In California, The 9.3% state income tax at the Finleys income level adds $6,990 to the annual conversion cost, a material increase that narrows but does not eliminate the conversion advantage. In Texas and Florida, zero state income tax makes the pre-70 window maximally efficient. Sandra has a 6-year pre-70 window, nearly twice Robert's. Her $185,000 traditional IRA, converted over 6 years at a pace that stays within the 12% bracket alongside Robert's ongoing conversions, generates the highest long-term value of any asset in this bulletin, because the converted dollars have the longest Roth compounding runway. Here is the sequencing. From 2026 through 2028, both Robert and Sandra are below 70. The household bracket capacity is $75,150 per year of conversion room. Applied first to Robert's larger IRA to reduce the primary RMD driver. From 2030 through 2033, after Robert's Social Security has begun and the household income has risen, Sandra's window at 12% has partially closed. But Sandra's window does not close entirely until her 70th birthday in 2033. During 2030 through 2032, the conversion analysis must recalculate. With Robert's Social Security stacking the income, the 12% bracket room shrinks. But it does not disappear immediately. In 2030, Robert is 70, Sandra is 67. Their combined income, including Robert's Social Security, is $124,600. Standard deduction, approximately $32,000. Taxable income, $92,600. They are at the top of the 12% bracket range. Additional conversion capacity, essentially zero at the 12% rate. The rate for additional income, 22%. The conversion still makes sense, 22% today versus 26.95% at Sandra's RMD age. But the urgency and the savings are reduced compared to the 2026 to 2028 window. The lesson for Sandra's IRA: the conversion sequence must prioritize the early years, 2026, 2027, 2028, when both spouses are below 70 and the full bracket capacity is available. Sandra's IRA should be converted in the years after Robert's bracket capacity is fully consumed, at whatever rate remains available. Any conversion at 22% or below today beats conversion at 26.95% after Sandra's RMDs begin. State nuance: Missouri's pension deduction for residents over 62 applies to Sandra's nursing income indirectly. The deduction reduces other income categories in ways that create additional conversion room in some years. A Missouri-specific tax projection is essential before sizing Sandra's annual conversion. In Pennsylvania, where IRA distributions are fully exempt from state income tax for residents over 60, Sandra's conversion would cost only the federal rate, making Pennsylvania one of the most efficient states for executing this strategy. Here is the asset I told you to hold. If Robert's $740,000 traditional IRA, rolled over from his 401k at retirement, includes shares of his former employer's stock, or any position that was held inside the 401k before rollover, there is a specific tax provision that produces a conversion advantage beyond the standard bracket savings. It is called Net Unrealized Appreciation, NUA. Under IRS rules codified in Revenue Ruling 98-27 and addressed in IRS Publication 575, employer securities distributed from a qualified plan, a 401k, as part of a lump sum distribution receive special tax treatment. The cost basis of the shares is taxed as ordinary income at distribution. The appreciation above the cost basis, the NUA, is taxed at long-term capital gains rates when the shares are eventually sold, not at ordinary income rates. For Robert, if his $740,000 IRA rollover included employer stock with a cost basis of $40,000 and a current market value of $180,000 inside the IRA, the NUA of $140,000, if handled correctly, could be taxed at long-term capital gains rates of 0% or 15%, rather than the 26.95% ordinary income rate that applies to standard IRA distributions or Roth conversions. The NUA strategy requires that the employer stock not be rolled into the IRA. It must be distributed in kind from the 401k to a taxable brokerage account as part of a lump sum distribution in the year of separation from service, retirement, reaching age 59 and a half, or death. If Robert has already rolled the employer stock into the traditional IRA, the NUA treatment is no longer available for those shares. But if Robert's former employer's 401k is still intact, if the rollover has not yet been completed, the NUA election on the employer stock must be executed before the rollover, not after. This is why the IRA asset audit must precede the rollover decision. The sequence matters. Evaluate NUA treatment before rolling over, execute the NUA distribution if advantageous, then roll the remaining non-employer stock balance to the traditional IRA, then begin the Roth conversion ladder on that remaining balance. Executed in the wrong order, the NUA opportunity is permanently foreclosed. For families where the 401k rollover is already complete and employer stock is inside the IRA, as is the case for most retirees who rolled over without an elder law or tax advisor reviewing the NUA question, the applicable strategy shifts. The appreciated employer stock position inside the IRA should be prioritized for Roth conversion in the pre-70 window because the conversion cost today at 16.83% is lower than the cost after 70 at 26.95%, and because leaving appreciated stock inside the traditional IRA generates RMD income based on the full market value, including the NUA, at ordinary income rates, which is the most tax-inefficient outcome of all. State nuance. Missouri recognizes the federal NUA treatment for employer securities. Missouri does not impose additional state tax on the NUA gain above the federal capital gains rate treatment. In states like New York, which has its own capital gains treatment that does not align perfectly with the federal NUA rules, the NUA strategy requires state-specific analysis before execution. California does not recognize favorable capital gains treatment for NUA and taxes the full NUA gain at ordinary income rates, making the NUA strategy far less attractive for California residents and shifting the priority back to standard Roth conversion. The three IRA assets, Robert's large traditional IRA balance, Sandra's smaller but longer Runway IRA, and the NUA eligible or conversion priority employer stock position, together represent the complete pre-70 conversion architecture. 3 assets, 3 strategies, all executable before the window closes, all producing compounding benefits that extend for decades beyond the conversion event itself. Let me bring Sandra and Robert back one final time. Sandra and Robert Finley have 3 years. Robert's 70th birthday arrives in June 2029. Sandra's in 2031. The window they have right now, June 2026, $52,000 in household income, $75,150 in 12% bracket room, 0 Social Security income stacking the MAGI, is the best window they will ever have for the next 30 years of their financial lives. It is not a special opportunity. It is not a tax break that Congress might extend. It is a mathematical consequence of their own income calendar, a window created by the gap between Robert's retirement and the activation of Social Security, and it closes on a birthday. If Sandra and Robert convert $75,000 in December 2026, before this calendar year ends, they pay $12,650 in federal and Missouri tax on that conversion. They move $75,000 from an account that will generate mandatory taxable distributions in 6 years into an account that will grow and distribute tax-free for the rest of their lives and for their children's lives. They reduce Robert's future RMD by approximately $3,200 per year. They reduce their 2033 IRMAA exposure by a measurable amount. They reduce their children's inherited IRA tax by approximately $21,000 on those dollars alone. For $12,650 today. That is the deal. $12,650 today in exchange for $80,000 to $105,000 in lifetime family tax savings. The IRS is hoping they wait. The IRS is counting on inertia. The IRS designed the system so that the path of least resistance, do nothing, let the IRA grow, wait for the advisor to bring it up, is also the most expensive path, measured over the full arc of retirement. It is June 2026. The Finleys have 6 months to execute their first conversion before the 2026 tax year closes. They have 36 months before Robert's Social Security activates and fills the 12% bracket permanently. They have the income documentation they need, the CPA relationship they should use, and the bracket capacity that exists right now and expires on December 31st of every year they fail to act. This channel publishes early warning bulletins. Within 48 hours of a change to IRS Roth conversion rules, a congressional proposal to limit conversion amounts, a Secure Act regulatory guidance update affecting the 10-year inherited IRA rule, a Missouri state tax change that affects the conversion cost calculation. When those changes land, and proposals to modify Roth conversion access have been floated in every recent budget cycle, you will know here before your advisor's next quarterly review. Subscribe, hit the bell. The families who model the pre-70 window in their 60s are the ones who use it. The families who discover it at 73 pay the bracket premium for every remaining year of their lives. Your sources are free and on the public record. IRS Publication 590-A, Contributions to Individual Retirement Arrangements, including the Roth conversion rules, is at irs.gov. Secure Act 2.0, Public Law 117-328, governs the RMD age and inherited IRA, changes that extend and define the conversion window. It is at congress.gov. Both documents together tell you exactly what the window is and exactly why it closes. Print them. Bring them to your CPA. Ask, specifically, what is my 12% bracket conversion capacity for the remainder of this calendar year? Be Robert, who executed the first conversion in December 2026. Don't be Robert, who told Sandra they'd look into it after the holidays and forgot. I'll see you in the next bulletin.